PrairieSky Royalty is operating the largest independently owned portfolio of fee-simple mineral titles and oil and gas royalty interests in Canada. The company's business model, defined by its pure-play royalty structure, effectively decouples the benefits of resource production from the capital-intensive and high-liability risks associated with exploration and production. The bear case: macroeconomic volatility and geopolitical risk. The bearish argument against PrairieSky focuses on external factors beyond the company's control. Despite its operational excellence, the firm is vulnerable to global supply-demand imbalances, shifts in international trade policy, and domestic regulatory hurdles. Commodity price sensitivity and global oversupply. The company's funds from operations are highly sensitive to benchmark prices. A $5 per barrel change in the price of WTI impacts FFO by approximately $24.5 million annually. Independent forecasters have warned that the global oil market may face a significant surplus in 2026, with production growth potentially outpacing demand by 2.1 to 4.0 million barrels per day.
The threat of trade tariffs and international friction. The re-emergence of aggressive trade policies in the United States represents a significant risk. In early 2025, the U.S. administration imposed 10% tariffs on Canadian energy resources, including crude oil, natural gas, and natural gas liquids. The threat of a broader 25% tariff on all Canadian goods in 2026 could hit Canadian GDP by nearly 1% and damage investor confidence. Regulatory complexity and ESG compliance costs. The finalization of enhanced methane regulations in late 2025 targets a 72% reduction in methane emissions by 2030. While capturing methane could lead to additional industry revenue, the upfront cost falls entirely on the operators. For small to mid-sized E&P firms, these compliance costs could redirect capital away from drilling. Similarly, the Impact Assessment Act, Bill C-69, continues to create uncertainty for large-scale infrastructure projects vital for market access.
The bull case: organic growth and geological option value. The bullish perspective on PrairieSky is predicated on the idea that the company offers the best risk-adjusted exposure to some of the most economic oil plays in North America. By owning the mineral rights rather than the operating interests, investors capture the upside of new discoveries and technological improvements without the downside of operational inflation or capital risk. Strategic growth in key plays. The company's growth is increasingly driven by its positioning in three key plays. Clearwater play. As the largest royalty holder in the Clearwater with 1.3 million acres, the company saw a 24% oil growth volume and a 42% increase in 2P reserves in 2025. Production from this play has grown at a 20% compound annual growth rate since 2022. Duvernay play. Royalty volumes surged by 90% in 2025, making it the fastest growing play. Growth is largely attributed to increased activity in the West Shale Basin. Mannville stack. Oil production in this play grew by 10% in 2025. It remains a strategic focus for repeatable, low-cost drilling, especially with licensed wells from major operators like Canadian Natural Resources. Technological innovation as a royalty catalyst. The adoption of advanced drilling and completion techniques by third-party operators serves as a hidden growth engine for the royalty holder. Multilateral drilling represented 40% of all activity on royalty lands in 2025, up from 36% in 2024. These wells significantly increase the productivity and recovery factors of the reservoir. Because the royalty is calculated on the total volume produced, the move toward higher intensity drilling increases PrairieSky's revenue without requiring any capital investment on its part.
Furthermore, the expansion of waterflood support, particularly in the Clearwater, where half of the volumes are now under secondary recovery, provides a highly sustainable, low-decline production base. These programs extend the life of the fields and improve the long-term visibility of the royalty cash flow. The defensive advantage of the tax shield. A critical but often overlooked component of the bull case is the company's fiscal positioning. As of early 2026, the company possesses $1.18 billion in tax pools. These pools allow for a 10% annual write-off, meaning that in 2026, the first $118 million of cash flow is entirely tax-free. Any incremental cash flow is taxed at a moderate rate of 23.5%, providing a superior after-tax cash flow yield compared to many of its peers. Company Deep Dive. The fundamental value proposition of PrairieSky is rooted in its ownership of 18.6 million acres of royalty properties across Western Canada. Unlike traditional E&P firms, the company does not conduct drilling, development, or production operations. Instead, it manages its land base to encourage third-party development at no incremental cost or liability to itself. This model eliminates exposure to capital expenditures, operating expenses, and environmental or reclamation liabilities, which are the primary drivers of cost inflation and financial risk in the upstream energy sector.
The cornerstone of the asset base is the 9.9 million acres of fee simple mineral title lands. In the context of Canadian property law, a fee simple estate represents absolute ownership of the land and its fruits in perpetuity. This status is critical for long-term investors because, unlike traditional leases or gross overriding royalty (GORR) interests that have finite lifespans or expire upon the cessation of production, fee simple titles never expire. This allows the company to grant successive leases to third parties, reserving a lessor royalty each time, thereby capturing multiple cycles of development as technology improves or commodity prices fluctuate. The asset portfolio is composed of two primary mechanisms: fee simple mineral title, 9.9 million acres held under absolute title in perpetuity; GORR interests, 8.7 million acres held as contractual interests for a finite duration based on lease terms. Total royalty land base, 18.6 million acres across Western Canada. In the 2024 fiscal year, the fee simple lessor interests contributed approximately 66% of the company's total royalty revenue. This segment also generated $30.8 million in bonus consideration from new leasing arrangements and $8.1 million in lease rentals, highlighting the multifaceted revenue potential of the land base. The GORR interests provided the remaining 34% of royalty revenue, demonstrating the importance of the contractual portfolio in augmenting the cash flow from the core fee simple assets. Financial performance and capital allocation strategies. The financial results for the 2024 and 2025 fiscal years illustrate a period of operational record-setting tempered by the realities of global commodity markets. In 2025, the company achieved record annual oil royalty production, averaging 13,940 barrels per day, which marked a 6% increase over the previous year. This growth occurred despite a 14% decline in the average USD WTI benchmark price, which exerted downward pressure on the top line. The efficiency of the royalty model is best observed in the operating margins. The company maintained a royalty operating margin of 99% and an overall operating margin of 88% in 2025. These margins are significantly higher than those of traditional E&P operators, as the royalty holder receives its share of the revenue off the top before any operating or capital costs are deducted by the producers. Financial performance for the 2025 fiscal year compared to 2024 included the following. Royalty production revenue, $441.7 million in 2025, a 5.2% decrease from $465.8 million in 2024. Total revenue, $478.2 million in 2025, down 6.1% from $509 million in 2024. Funds from operations, FFO, $353.0 million, 1.50 cents per share in 2025, a 7.2% decrease from $380.5 million, 1.59 cents per share in 2024. The decline in FFO and revenue in 2025 was primarily the result of the 14 to 16% drop in benchmark oil prices, which offset the company's 6% organic volume growth. This dynamic underscores a central tension in the investment narrative. The company is a highly efficient volume-growing machine, but its ultimate financial success remains tethered to the global price of energy. Capital allocation, dividends, and share repurchases. The company's philosophy regarding capital allocation is focused on returning the majority of cash flow to shareholders. Since its initial public offering, it has returned $2.4 billion to its owners, including $2 billion in dividends and over $400 million in share buybacks. In 2025 alone, the company declared $243.4 million in dividends and repurchased 6.2 million common shares for $158.5 million under its normal course issuer bid, NCIB. This aggressive repurchase program resulted in the cancellation of 2.6% of the outstanding shares. For the 2026 fiscal year, the annual dividend has been increased by 2% to $1.06 per share, reflecting management's confidence in the stability of the underlying cash flow. Valuation. PrairieSky generally trades at a premium to its peers, reflecting its perpetual fee-simple land base and high oil weighting. Comparative metrics: PrairieSky, trailing PE of 35.8x, dividend yield of 3.4%, and an operating margin of 98%. Topaz Energy, trailing PE of 37x, dividend yield of 4.5%, and an operating margin of 96% for its royalty segment. Freehold Royalties, trailing PE of 21.1x, dividend yield of 6.5%, and an estimated operating margin of 85%.
Sensitivity analysis, modeling 2026 fiscal resilience. The relationship between benchmark prices, exchange rates, and funds from operations can be expressed as follows. For 2026, the company estimates that for every $5 per barrel change in the price of WTI, annual FFO shifts by approximately $24.5 million. Similarly, every 0.01 cent change in the USD to CAD exchange rate impacts FFO by roughly $4 million. Operational counterparty risk and producer concentration. PrairieSky is well diversified with over 325 distinct operators. However, activity levels are heavily influenced by operator segments. Large-cap operators like Canadian Natural Resources provide a reliable long-term volume base through disciplined growth and infrastructure optimization. Mid-cap operators often drive large volume spikes through high-intensity pad development in plays like the Duvernay. Junior and private operators drive frequent new lease issuances through aggressive drilling in heavy oil plays like the Mannville and Clearwater.
In 2025, third-party operators spud 718 wells on PrairieSky's properties, representing $2 billion in gross capital investment. Canadian Natural Resources reported record production in 2025 and plans a $6.3 billion capital budget for 2026, including 448 new wells, many in areas where PrairieSky holds interests. Future guidance and strategic capital allocation. The company's 10-year outlook suggests that it could generate between $2.4 billion and $7 billion in FFO, depending on the macro environment. In 2025, strategic capital allocation was divided between two main priorities. Acquisitions. The company completed $100 million in acquisitions in 2025, primarily targeting fee lands and royalty interests in the Mannville, Duvernay, and Clearwater. Share repurchases. Under its NCIB, the company spent $158.5 million to repurchase and cancel PSK common shares, increasing ownership for remaining shareholders. Conclusion. The bull case is anchored in exceptional 98% margins, dominant land positions, and aggressive capital return. The bear case centers on high sensitivity to WTI prices and escalating trade friction with the United States. For long-term investors, the perpetuity of the fee-simple mineral titles and the record growth in oil reserves suggest that PrairieSky is structurally positioned to weather commodity cycles, provided that operator drilling activity remains robust.